I try to convince people to slow down AI, to regulate AI.
Of all of them, there's the debt growth that finances the bubbles that happen before it that create the busts.
Elon Musk and Ray Dalio, two of the best investors of all time, are in unanimous agreement about this one word:
recession.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go.
What started in America last year has now spread to every part of the world.
You're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%.
Now pay very close attention to this next segment, because this revolves around how a coming recession or a market downtrend in a significant way is almost instantly going to cause the Moass.
Yes, it is. 8.7 is where we're at the moment, but we gained nearly 11% at one point this morning. And again, it's all down to Volkswagen. What is going on here is unbelievable. The share, it nearly doubled this morning. It reached a level of 1,005 euros, and already yesterday the car maker rose 147%, causing the DAX to stay in positive territory when the rest of Europe was declining. What is really going on here is very hard to say. It must be the worst case scenario short squeeze one can in fact imagine, and it's all about Porsche saying over the weekend that they hold 42.6% in Volkswagen currently, and another 31.5% via options. So indirectly, Porsche holds nearly 75%. The federal state of Lower Saxony, they hold another 20.2%, so just over 20%. So effectively, there's only a tiny free float left of just under 6%, 5.7%. And if everybody is short in a share with such tiny free float, if those two things come together, then that can cause these severe disruptions that we're seeing again today. Or as one analyst, he put it, each and every short seller in the world is trying to close up their positions, and there's no way they can do it except for trying to buy like mad. So it's panic among investors. Many had bet on VW's share price to fall. So the share's recent move, it's all down to covering of short positions rather than any fundamentals, because they don't look as good as you might suggest when looking at the share price.
That clip from the Volkswagen short squeeze back in 2008 sounds a whole hell of a lot like what's going on with AMC. We have effectively done what Porsche did to Volkswagen in 2008, and that is buying up the free float, restricting that free float. So as we are holding on to the stock, there is very few shares outstanding that shorts can actually cover from. That is why we have been seeing very low volume, and ultimately once we go into a market downtrend or some form of recession, that's when we're going to see the Moass, because after all, hedge funds do not perform very well as of late. Hedge funds in the month of November lost 2% on average, and we have went over countless other funds that have posted record losses in the month of December. So we can only imagine this number is at least 5% or higher. But why I am really making this video right now is because we are seeing signs of a recession coming sooner rather than later. Now, at the end of this video, I do want to give you guys my input, what I think is going to happen. I think it makes a lot of logical sense, and I think most of you guys will agree with me. So take a look at this article from January 4th, 2022. Bond King Jeffrey Gundlach: the yield curve may be sending a recessionary signal. And if we do scroll down, it says his warning on the path of the U.S. economy, in part caused by looming interest rate hikes by the Federal Reserve. That perhaps warrants the most attention by investors, large and small, after a strong run-up in equity prices last year. In quotes, we have the highest 2-year yield of the past year. We have the highest 3-year yield, but we have basically a high on the 5-year yield. And so what's happening is the year's yield curve is sending a bona fide recessionary signal. You have interest rates going up at the short end and going down at the long end. The basic mechanics of a flattening yield, which could then lead to an inverted curve as a recession predictor, goes a little something like this. Markets start to worry the Fed will slow down an overheated economy by increasing interest rates, which in turn triggers an economic slowdown. That then leads to a period of renewed lower interest rates from the Fed as they attempt to stave off a recession. To wit, a yield curve inversion has preceded every recession of the past 50 years. Indeed, this junction may be where markets are at present as the Fed seeks to turn into an inflation fighter inside of a global health pandemic by 1, winding down its quantitative easing campaign, and 2, signaling a path of higher interest rates in 2022 and beyond. If you are unaware of what quantitative easing is, it's a complicated word for saying money printing, for buying assets. And that's really key to all of this. An inverted curve has predicted all of the recessions in the past 50 years. So we're not quite there yet, but we are heading in that direction. If you're curious where the actual rates are at the current moment, the yields, the 10-year Treasury note is at 1.666%, 1.66% at 3 p.m. on Monday. That's the highest since October 21st based on 3 p.m. levels. The yield on the 30-year rose 6.1 basis points to 2.077%. And then it says the 2-year Treasury note declined 2 basis points to 0.74%. So essentially, if the 10-year rises above the 30-year, that's an inverted yield curve. And we are at 1.66 for the 10-year and 2.07 for the 30-year. So we're getting very close. And that would be the inverted yield curve. But everybody wants to scare you with the inverted yield curve, a recession. And you might think a recession is a bad thing, which generally speaking, it's not a great thing. But more millionaires were created during the Great Depression than in any other time in American history. Why is this? Well, because during an economic slowdown, it is a great time to start a business. Startup costs are much lower in recessions than in boom periods. Savvy investors edged in and positioned themselves for when the economic climate improved. In the 20s, you may be surprised that many people with small amounts of liquid cash were able to buy bankrupt businesses at bargain prices. Towards the end of the 1930s, some business people watched the upsurge in military spending by some countries. The world was preparing for war, and those that had invested in companies that made in-demand products for the government stood to make a lot of money. Companies dealing with shipping, military vehicles, textiles for uniforms, tents, etc., metals, copper, steel, aluminum, and iron, shipping, and petroleum products made a fortune. Well-known companies that were bought at this time were John Deere, Reynolds Metals, and Douglas Aircraft. Another huge opportunity was real estate. But something a lot of people don't always talk about when it comes down to a recession is the stock market as well. Stocks go on incredible deals. And if you had bought stocks, certainly in the 30s, no doubt about that, that's very obvious, but even in 2008 you would have made a ton of money. The S&P 500 index has went up 400% since 2008, since the lows of 2008. But at the same time as that, you start to see a ton of short squeeze trades happening at the bottom of the markets. Why is that? Because hedge funds that have all of this liquidity right now due to quantitative easing, due to a strong economy, now have less liquidity. And once we start to force them to cover on their short positions, or to at least get margin called, they don't have that kind of money to service those margin calls. So as long as we hold on to the free float, once that happens, they have to start covering because the money has just evaporated. Their performances suck, and they don't have that liquidity they need to stay in their short positions. And if we restrict the free float, they are going to be scrambling to find the shares available to cover on their short positions, and that is ultimately what is going to make us a ton of money. So the word recession is not a word that should be feared. The word recession is a word that you should take with great stride. You should embrace this. Either way, it's going to happen, and it's going to make you a lot of money if you are well positioned for it. My personal take on this whole situation, it's pretty simple. We have seen all of this stimulus over the past 2 years now come down to a halt. We're seeing the Fed that has been buying $120 billion of treasuries as well as mortgage-backed securities every single month now are almost done doing that. So that's a form of stimulus that is now gone that has been supporting the marketplace. The child tax credit, stimulus checks, mortgage forbearance. You have, as well as all of that, student loan repayments now have to start in May, and you also see the Fed that is starting to raise interest rates at a very aggressive pace for inflation that is going to be transitory. And what is the number one cause of a recession? It is lack of consumer demand. In other words, people stop spending as much money. The velocity of money goes from, say, 5 down to 2. So the money in the economy is not circulating around enough, and you're not seeing enough demand. And what is the first signs of a recession? Measurable levels of spending and investments are likely to drop. That is what we are seeing right now. You're seeing the stock market going down, investments are dropping, but you have not quite seen the levels of spending go down. And you're probably not going to see that until the second half of 2022, as people have ran through their tax returns. There's no more stimulus being sent out, and we also have over 10 million jobs that still need to be filled. So all in all, I would bet on a recession coming by the end of 2022, and the definition of a recession is 2 consecutive quarters of slowing growth. So if you see Q3 and Q4 with slowing growth in 2022 and a substantially less robust economy around Christmas time of 2022, that's when you're going to hear this word recession has been declared, and you will see that liquidity being crunched. And if you're an AMC investor, that means you're going to make a whole hell of a lot of money once this short squeeze does start. Because what people also fail to tell you is that, yeah, Volkswagen happened in 2008, but there was short squeezes happening almost every single day because the liquidity had just dried up. So that is going to be all for this video. Hope you guys enjoyed it. Hit that like button for me. Consider subscribing to the channel as well. If you guys want to support the channel, links down below in the description to do so. Check out Webull. Deposit $100, get 6 free stocks for a limited amount of time, as well as deposit $100 with Public as well. I don't believe you have to deposit $100, but $100 is a good starting point with Public. They do not use payment for order flow whatsoever. Your orders go straight to the lit exchanges. You will also get 1 free stock worth all the way up to $1,000 by doing that. So check that out. Love and appreciate you guys. Thank you for watching. I will see you in the next one.